Let me start with the caveat. Experience, patience, long-term investing, these are all difficult to teach, right? I can't teach you experience, I cannot teach you patience, but I can tell you what was required, what is likely to be required, and why, what are the things which you should be doing in the long run to be a great investor. So first of all, long run investing or long term investing is easy to talk, very difficult to achieve. Most of us go and say we will achieve this, but we are unable to achieve for various reasons. Most relationships which we start is makes an assumption that it is for the long term, whether it is a marriage, whether it is a friendship, or anything like that. But not all relationships last. Forget forget marriages, we'll talk about marriages separately, but even friendships. You met maybe 200 students with whom you passed your class 10, right? Maybe there were 200, 300, 400 in your school. Today, 20 years later or 30 years later, will you be able to write down the 200 names? Very, very unlikely. Maybe you will write down 20 names with whom you have been in touch. Maybe you could write down another 20 names with whom you are not in touch, with whom you wish you were in touch, or another 20-30 names which you remember but with which you don't, with people with whom you don't want to be in touch. So at best you will do 40-50, not more, not nowhere near 200-400, and you will always justify saying I never knew 400 people were there and I never knew them even in school. That's fine, but it's not easy to do long-term relationship even in something like this. So marriages fail, some marriages fail in 3 months, some fail in 30 years. So again, a long-term thing. Another thing is long-term, when you talk of 30, 40, 50 years, is not a series of short-term things. So let's talk about pleasure. Short-term pleasure is eating a rasgulla maybe, right? So it's short-term pleasure. You can do it 4 times a day, every day, and you will have a sugar problem, right? You will have too much sugar in your body. I am not getting into the medical thing, as if you exercise it's okay and all that. I am not getting into that, but a series of short-term pleasure is not long-term pleasure. Long-term pleasure could be in saying, okay, I will avoid sugar, I will do this, I will exercise, I'll get up in the morning. So getting up in the morning, going for a walk, for people for whom it's a habit, it's easy to do. For some people it's like, oh my God, what a huge sacrifice I'm having to make, so they don't do, they can't do. And so a series of small-term pleasures is not equal to a long-term pleasure. So similarly, if you are an investor in the for the long run, you should not be looking at the daily losses that you are making because you think you could have sold and bought and things like that. All that is very tempting, but first of all, stop looking at the short-term fluctuation in your portfolio. Or even if you look at your portfolio not at individual shares. You've got share A which has gone up 20% and share B which has gone down 20%. On an average in your portfolio, you're fine because both are the same price, and you have the same price in the same quantity, or similar price and similar quantity. Then it is different. But if you keep looking at it on an hourly basis, weekly basis, monthly basis, and you don't have the self-control, chances are you will not be a good short-term, long-term investor. And you may not be a great short-term investor too, but you will definitely not be a good long-term investor. When you are into a long-term investing, the first thing I would suggest to people is to associate yourself with long-term investors. Go and read a Graham. Yes, things are very different from what Graham wrote. Go and read people who say you have to be in it for a long term. Look at read all long-term investment, which means read Fisher, Buffett, Graham, all of those people who have invested, Charlie Munger, who have invested in the long run. And don't look at too many YouTube advisors and people who are trying to teach you long-term investing. Long-term investing is a lot about patience and about recruiting a team which believes in that, including a wife who thinks that increasing net worth is a far greater pleasure than spending money and not putting enough money back into compounding. Yes, of course, you need to learn how to spend also, but the question is, if your wife thinks very differently from you, or if your investment advisor thinks very differently, your CA thinks very differently, your parents are influencing you, saying you don't know, in the long run we'll all be dead, why should you accumulate so much, let us spend, or things like that, then again you're in trouble. So you need an environment. So first of all, create an environment where everybody thinks like that. It's very difficult to make people understand that you can think very differently. For example, imagine a 60-year-old that telling his investment advisor, I'm not looking for better returns, I'm okay, I'm happy with the returns that I'm getting, I'm not looking to save tax, I'm okay paying the tax that it will incur. I realize that if I earn money in a poor country, I will have to pay a disproportionately higher tax. I can sit and crib about it, but then so all this is part of your long-term investing. Another very important thing is, to be a good long-term investor, you need insurance. And insurance, I don't just mean critical illness and medical insurance, or taking a term insurance for the rainmaker. That, of course, apart from that, a good qualification is an insurance that your income flow won't stop, or you call it luck, you call it whatever, right? So and the longevity for which you can do it. This brings me to a very interesting topic. I was just going through the career profile of Prem Chopra, a very famous Indian villain. He's been acting for 6 years. I don't know whether he's still acting, but his acting career has been 6 years. Now imagine this person started an investment SIP when on the day he started his work, and he continued it for 6 years. How many of us can contribute for 60 years? Right? 60 years you're actively contributing. It happens to very few people. Even assuming you start at 22, 23, maybe 25, you will retire at 55, right? At some stage. So 30 years of contribution is what happens. You take Buffett, started at 11 and still contributing because of the power of compounding, and still earning money and being able to contribute. 70 years of compounding. No way how a sportsman can do that. It has to be only of, I mean, when I'm talking of Prem Chopra, I'm talking of Prem Chopra as a movie person. He's a villain, but he keeps getting roles. Now the question is, if you had if you were a cricketer, if you were a Sachin Tendulkar or Virat Kohli or anybody, Virat Kohli's career is even shorter than Sachin. He may have technically earned more money during that period, but the compounding effect for a Sachin Tendulkar will be longer. So you need to understand that longevity is very important in long-term investing, and it's very difficult to hold on, especially when there is, which brings us back to Rudyard Kipling's, when everybody else is losing their head, if you can keep your head, the world is yours, right? The world and everything in it, or something like that. I'm quoting from memory. And sometimes for the same decision, you can look like an idiot, or somebody can say, once something is successful, you will get judged. So I know one promoter who pumped money into his company when there was a terrible recession, right? So everybody said, oh, ye pagal ho gaya hai, he's putting money in a business which is closing down. But after that, when the steel boom happened and he raked in so much money, people said, what a visionary. So that line between being stupid, being stubborn, not listening to people, and doing what you think is right, if it is successful, you will be called a visionary. If it is a failure, they'll say he's so stupid. He just does not listen to the advice given by so many advisors. The McKinseys of the world are all there to give you advice. Largely, they give you advice which is suitable to you. You will also understand that some share which you have bought, like I bought some share in say 1986. From 1986, I've seen it maybe fluctuate, but I've seen it here. I'm convinced that I will not be able to see the decline, or I will not be able to see the decline here. I will continue to think it is going up. If it comes down, I will pretend that it has not even come down. I say, oh, this is a temporary correction. Last quarter results were bad, or something like that. But if there is a change in the management, change in the culture, it's very difficult to know unless you're talking to the management on a regular basis, which really can't happen with all the companies in which you have invested, right? So when it starts to decline, even when the market starts to decline or anything like that happens, we may not even understand, because we are so invested in it. We may not be able to appreciate that it is the company is going down. So that quick cut off on a long term position, on a 40-year position, to cut off It may not take 40 years, but it will not happen in 40 minutes, right? It will take time. It will not happen in 40 hours. It may take 2 months, 3 months, right? So 3 months would mean 12 weeks. It doesn't take 40 years, but it takes a long time. This could be a long time if the fall is going to be dramatic. It is also the question of how much of cash you keep. So this is very important, that the cash that you have should allow you to say, okay, in case there's an emergency, I have the cash available. That cash, don't look at return on that cash, doesn't matter. That cash is to give you comfort. You don't look for a return. I mean, I don't look for a return on this coat, I don't look for a return on this shirt, right? These are expenses, that's all. So similarly, cash is an expense. It looks very expensive when the market is booming, and you look like a genius when the market comes down. So that's important. So take the average what you are saving, because you have kept that cash, and that can be humongous. So understand why you have kept that cash. So have that focus. Once you have some of these things, and also be willing to, like I keep telling senior citizens or older people, that you have 3-4 buckets, right? When the markets are doing well, withdraw from your equity bucket. That's the best place to invest. So if you have bucket number 1, which has got a lot of liquid assets, bucket number 2, which has got some liquid assets, but largely kept for growth, and bucket number 3, which is kept only for growth, and bucket number 4, which is kept for charities. We may not even bring it in. Bucket number 3 is the best place to withdraw when the market is doing well. When the market is doing badly, you withdraw from bucket number 1. So these things, these kind of flexibility from where to withdraw, and you say, oh, the market is down 10%, so let me stop withdrawing from bucket number 3, let me start withdrawing from bucket number 1. Making these switches, all this will go a long way in trying to build your portfolio, your equity portfolio in the long run. Thank you.